Everybody, ladies and gentlemen, hello and welcome to us here at Nadex. My name is Philip and I will be once again your presenter for today's webinar. Today it's an introduction to binary options, our revised edition of this webinar. Our regular attendees know the drill by now. If you can hear me well, if you can see my slides actually changing, I would appreciate a very short yes or why in that small questions box that you can see on your screen, just to make sure that the technical aspects have been taken care of. And guys, if you happen to have any questions, please put those questions into that box. I'll try my best to answer those questions as we move through the webinar. It's an introductory type of webinar, so you're definitely not interrupting my flow. I appreciate those questions. We want to learn something together here, so please don't be shy. Just ask, and I'll do my very best to give you the proper answers. Today's webinar is scheduled to run somewhat between half an hour and an hour. We will see how many questions you have. I don't want to cut your question short, so by any means, if something is not clear, once again, please ask. Before we start, you already see our first risk disclaimer here. Please, I have to make you guys aware of those. Take a moment of your time, read through them carefully, and make sure that you are comfortable with them before continuing with the webinar. Essentially, this says that trading involves risk, and you should understand those risks, and you should understand the instruments you're using before you're getting active in the market. Quick hint, that's why we're here today. We want to learn more about binary options, so taking care of that, understanding the instruments and the risk profile of those instruments. As neither TradeWith Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only, especially true for the live part of today's webinar. We will be looking at the markets together. Once we've understood how those binary option contracts actually are structured, I want to see if there's something potentially applicable in the market right now. And I want to illustrate to you guys the thought process that I have when I'm considering which option contract could I now pick for trading a certain setup in the markets. But this is really just for illustrative purposes. It's definitely not a trade recommendation. Trading for me is a good part about waiting. I want to see my perfect setup occurring in the market, and then I want to be ready. Just like a sniper laying low, waiting for the perfect shot. And once I get my view, once I get my target in sight, then I want to execute that trade. Just because I think I want to be trading right now doesn't mean that the market has to give me an opportunity right now. Very important concept to understand and really to utilize in your daily trading. So once again, it's just for educational purpose. So please make sure you're okay with this. And guys, I really appreciate the feedback here on that quick sound and visual check. Thank you very much, guys. Here we also do have the Nadex risk warning. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes including forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, today's webinar, of course, is brought to you both by Nadex and TradeWith Position. I would like to kick off with a very brief introduction of those two companies. TradeWith Position has been founded in 2006 by Nick McDonald. If you Google him, if you have a look around, I'm pretty sure you will find many things about him. And the story how everything started actually is quite funny, because Nick just wanted to trade the markets, and he opened an account with his broker back in the day, and he started to trade those markets. But obviously he was doing this quite successfully, because one day his broker phoned him up and said, "Nick, couldn't you please teach our other customers the way you are trading?" And this is how actually TradeWith Position started. He never had this idea, I want to run a trading education company. It was actually demand from the market, please teach us your style of trading. And this is how everything got started. We have been providing international trader training for clients of global brands, including exchanges and brokers worldwide since then. And our cooperation with Nadex started back in 2011. By now you have realized I'm not a professional presenter. I'm sorry about that, but I'm a professional trader, which means I trade those markets for a living, the same markets, the same tools, the same platforms as you guys are using. We are a company run by traders, for traders. I know this 100% to be true for all of my colleagues here at Trade with Precision. We have specialized in technical analysis-based trading strategies. So we don't care what the market actually is. We don't care what the time frame is, as long as we have a trending market, as long as we have good volatility and good liquidity in that market. Our strategies should be applicable to those markets. Nadex is a derivatives exchange subject to regulatory oversight by the CFTC and has been founded in 2007. Just like all the other big powerhouses and players of the financial futures and options industry, it's based in Chicago. All contracts are settled in cash, so you don't have to worry about the contract specification and the modes and modalities of delivery, and how everything is being taken care of once those futures and options start to settle. Here at Nadex, everything is settled in cash. That's a huge relief. If you have traded futures in the past, depending on the contract, things could get a little bit exciting from time to time. When it comes to trading, I really like boring, because boring makes me money. If something is exciting, usually something is not going quite well. I like boring when it comes to trading. Wide range of global markets to trade, access to many different markets, and all this from one single account here. You don't have to have an account if you want to have exposure to the forex markets. If you don't have to have a different account if you want to have exposure to commodities, cryptocurrencies, it doesn't matter. You have all those markets available for trading here from your Nadex account. And the instruments to trade those markets are binary options and spreads. Somewhat related to each other, both are definitely not difficult. Today we want to focus on actually what are binary options and how can we use them to trade those markets. So you have access to the markets, of course, from your browser. You have the Nadex platform is available from any browser, pretty much on any device. So although there are apps, let me grab my laser pointer here, I will need that one later on. Although there are apps available on those app stores, you can just fire up your browser and the platform should be available in that browser just as well. We will be using the platforms in a few minutes, and this is all happening just from our browser. So any operating system pretty much and any up-to-date browser should be good, and you have access to those markets, not just for initiating trades, but also to monitor your positions or to scan for new opportunities while you're on the go. Today's agenda, we want to kick it off with an introduction to binary options in action on the live trading platform, dissecting the binary contract components, assessing the various strike price scenarios, binary option pricing components, and we want to close today's sessions with how you guys can take it up a notch and start trading here with Nadex today. Just a quick reminder, guys, if there are questions, please let me know. Introduction to binary options. Binary sounds rather technical and lots of computer science and programming. Just a little bit. It's rather easy. It's just like Boolean logic. You think about something is either true or not. If you have an electric circuit, either there is power on that circuit or there isn't. Either the light bulb is burning or it's dark. Simple as that, two states. A state of one of two mutually exclusive conditions, such as on or off, true or false. That is all that is meant by binary. So what does binary actually mean for our trading? Well, a binary contract, once this contract settles, we have always to distinguish between the period when this contract is still trading, leading up until expiry, and when this contract actually expires. At the point of expiry, when the life cycle of that contract is over, the outcome of those contracts has just two possible scenarios. Either that contract is in the money or it isn't. And this in the money means that the price of the underlying is either trading above the strike price, then we do have that true scenario, or it's not trading above the strike price, and then it's the false scenario. Please note that we can say here it's trading above the strike price. So it's really, mathematically speaking, a larger than. It has to be larger than the strike price. If it's trading at the strike price, then it's still that false scenario. Pretty much happens never, but just to be precise here and to keep that in mind, it's always when we refer to binary that the true event is the price is above the strike price. So if it's trading below that strike price, we do have that, or at the strike price, we do have that false scenario. And the great thing is we can profit both ways. We can both profit from a true or a false scenario because we can both buy and sell those binary option contracts. Now, if you have had a little bit of exposure to options trading before, usually selling options without having them bought first is considered to be a rather risky position. Depends on what you do and how you do it. Potentially speaking, you have unlimited loss exposure or loss opportunities there, or risk of losses. The great thing about Nadex contracts here is that both your reward and your risk is known upfront, and your risk is always contained. You know exactly how much you can potentially lose if everything goes wrong. You know the maximum loss upfront. Jonathan, thanks for that feedback. Never had this so far myself, but yeah, just for those scenarios, Jonathan just mentioned that he had one option contract expiring at the strike price, and yeah, sure enough, can happen, and for that reason we try to be as precise here as possible. So for the true scenario, for the payout scenario, we are looking at a price larger, of the underlying larger than the strike price. So coming back to risk, coming back to reward, a binary option represents a fixed risk and reward contract. With conventional plain vanilla options, it's always the question, how deep in the money is that contract? So you neither can precisely define both your upside and your downside at the same time when you're just talking about one single contract without going into any multi-leg strategies here. Nadex contracts, Nadex binaries, they are always trading in a price range between 0 and 100. This is leading up until we have the expiry. 0 and 100, it can never trade below 0, no matter how far out of the money that contract is, or it can never trade above 100, no matter how deep in the money that contract is. So the trading range, the price range of that contract leading into expiry will always be between 0 and 100. So maximum reward and risk are definitely known upfront, and they are also clearly displayed. Position sizing is so absolutely easy when we're looking here at the Nadex platform. I will show you this in just a few minutes. Especially trading forex is rather difficult because if I want, obviously I'm based here in Germany, you know that by my accent. If I want to trade, my account is in euro for normal forex trading. If I want to trade US dollar against the British pound cable, I now have to do additional currency conversions for euro into British pound and US dollar to make sure that my risk is contained. Here with Nadex, I see my risk upfront, no problems there, no issues, and I can trade much faster, much quicker, also on lower time frames. Maximum reward and risk are known upfront. And coming now to the expiry, leading into expiry, 0 to 100, everything in between is possible. At expiry, once those contracts expires, it's always 0 for the false scenario, or a payout of $100 in the true scenario. So each binary contract bought, sold represents $1 per point movement in the contract with a possible 100 points. Let's have a look at that with a little bit of graphics here. So the price is always between 0 and 100. And those of you who know a little bit about plain vanilla options, there are those Greeks, those KPIs that help you to understand the movement and the pricing of those plain vanilla options. And actually the price of this Nadex contract here, the binary contract, can be thought of or it can be, yeah. If you think that the delta of a normal call option is between 0 and 100, or 0 and 1, the price of that binary contract here pretty much behaves in the same way than the delta of that option. If that contract here is deep in the money, the price will be very, very close to 100 and it will remain there, even if price comes down a few points. If it's very far out of the money, price will always be very, very close to 0. You have a little bit of time value left, so it won't be precisely 0 or it won't be precisely 100, but apart from that, very close to that. However, if the price of the underlying market is trading right at the strike price, you should get a price here which is pretty close to 50. I find this is a very useful characteristics of pricing those Nadex contracts, because it helps me to actually and actively manage my position using different price targets. And one important thing is really I can trade around those binary contracts. It's not fire and forget. I do not have to put that position on and then hope and pray that the outcome is in my favor. No, I can actively manage that position. I can take profits early on. I can apply stop losses. I don't have to, because I know the risk up front and I can do my position sizing accordingly, but I don't have to. But I can if I want to, if it gives me more opportunities. So pricing of that binary option is always between 0 and 100. Guys, so far everything is clear, or do you have any questions? Once again, we're running those sessions for you, and we want you guys to go out here and say, I've understood it, I feel confident that I'm looking forward to opening my demo account and place those first trades and getting hands-on experience here. So if anything is not clear, please let me know. Now, if the contract is always trading between 0 and 100, what is my risk and what is my reward? My potential risk and my real risk, but my potential reward for trading those contracts. Let's think about it. If I want to sell a binary, why would I sell a binary? Well, I think price will close or should be closing below the strike price or at the strike price. So we get to the false scenario. In that case, the payout will be 0 and I will be able to keep what I got for selling that contract in the first place. Now, I hope you can see that if that contract is currently trading at 25 bucks, what's the best thing that can happen for me? Well, price will stay below the strike price and will expire there. So the best thing for me to happen is I will be able to keep those $25 which I just got. My worst case scenario here is, however, my analysis has been wrong, or the market just doesn't want to play along this time, which is perfectly fine. Trading is all about probabilities. I definitely want to do away with that idea that trading is all about having only winning trades. That's complete nonsense. This will never happen. It's all about probabilities and playing those probabilities right with good reward to risk management. So selling something for 25, if everything goes according to plan, I can keep those 25. But if things don't work out, the price moves above the strike price and settles above the strike price, I will have to settle that contract for $100. Remember, payout at expiry, if it's above the strike price, will be 100. So what is my risk? My risk in that scenario is $100, but I got 25 for selling that contract. So my absolute risk here is really just $75 remaining. However, this is still not great and far from awesome. I sold it for 25. My reward, my maximum reward could be 25. My maximum risk, however, is 75. And I'm getting a reward to risk ratio here of just 0.33 to 1. In other words, I'm risking $1 for the potential opportunity to make 33 cents. This is not the kind of game I like to play. I want to have both the odds in my favor, which means I want to win more often or potentially more profitable trades on my hands as losing trades. For that, I use my technical analysis. But then if that trade works out, how I wanted it to be, then my reward should also be at least the same amount for which I went when I risked my money when I put on my initial trade. Let's have a look at another example here. Same idea. I want to sell this market. By now, I can sell this market for 75. What's my best scenario? Price goes down and will close below the strike price. So I will be able to keep the 75, which I just got for selling that contract. However, if things don't play out, market rises or remains where it is, settles, I have to settle that contract for $100. So I got 75, I have to pay 100, so I lost 25. Same numbers, but just turned around now. My maximum reward is 75, my maximum risk is 25, but now my reward to risk ratio here is 3-to-1. Much, much better than just I have to risk $1 for the opportunity or for the potential to maybe make $3. Much, much better here than the other way around. You have to pay for that with probabilities, because here in this scenario, why is that contract currently trading at 75? Because it's trading in the money. Currently, the price of the underlying market probably is above the strike price. Otherwise, that contract wouldn't be priced here in this area. So price actually has to move in my direction to give me that potentially profitable trade. In this scenario here, price already is pretty much where I want it to be. It just has to stay there. And this is just coming from a mathematical point of view, probabilities, normal distribution of log yields. This is more likely for price to stay here, and here it is more likely for price to stay there also. Here, price has to travel, which is rather unlikely or more unlikely in order to give me my winning scenario. So here I pay for this better reward to risk ratio with an offset in my winning or in my potential successful probability here. Goes a little bit too deep right now, but people always tell me after seeing that slide, Philip, if 3-to-1 is great, why don't I just shoot for the swing for the fences and get something where I can get 1-to-9? Because usually the probabilities are here so bad that there's a reason why that contract is so expensive or why that contract is so cheap. Keep that in mind. Just like with everything else in life, you probably want to have some kind of balance. You want to have a good reward to risk ratio, and you want to have at least a decent probability that things work out. Going to the outsides of that probability distribution and swinging for the fences can work out, but it's just a way more risky game. It's not my type of game, so I can't tell you much about it, but just to keep that in mind. On that slide, we had a look at selling binaries. Obviously, if we're looking into buying binaries, the same logic applies. I think the market is going higher, so I want to buy a binary. If I can buy a binary, which is currently already trading above the strike price, I can buy it for 75. How do I know that that contract or that the market is trading above the strike price? The price is above 50. Remember, if an underlying market is trading pretty close to the strike price of that contract, the price should be somewhere close to 50. Could be 40, could be 60, but I would be really surprised if the price was 20 or 80. Trading around the strike price, price should be close to 50. So here I have a contract already deep in the money, trading for 75. How much can I gain? Price doesn't have to move much. For that reason, I'm paying more. I have a decent probability of things working out, but my maximum reward here is again just $25. My maximum risk, however, the market reverses, news comes out, I don't know what's going on, but however, we see a steep drop in the market. I can lose all those $75 which I just have paid for entering that position. So same story here, reward to risk ratio, I have to risk $1 in order to make potentially 33 cents. On the other hand, if I buy a market where I think that market is doomed to go higher, can happen, doesn't have to happen. Again, it's all about probabilities. I can buy this market now, or I can buy that option now for 25. It's not in the money yet. Price of the underlying is trading below the strike price, but I think that market might be going higher. And for that reason, if it closes above the strike price, that contract, which I just bought for 25, will settle for 100. My maximum reward is 75. My maximum risk is the $25, which I paid for that contract. And now I do have that reward to risk ratio of 3:1. Guys, so far, any questions? The basic idea here is really trying to balance the reward to risk ratio with the probability, and understanding and visualizing what has to happen for price action in order to move, or where does price have to move in order to give me for me, potentially profitable scenario. Let's have a look at all those things in action. The basic idea for me is always, I do not want to trade binary options or spreads. I want to trade a setup which I see in the market. And then I decide which is the proper way to implement that setup, to implement my strategy that I see in the market. And only then do I pick if I'm going for a binary or for a spread. But for me, for my style of trading, technical analysis always comes first. I always want to see a potential setup. And guys, what we're looking for in those setups today should be all about binary options. So I do not want to go into too much detail here. Our other webinars where we teach those strategies, and also the webinars where we talk about the market movers, those are much more focused on technical analysis. Let me just say here, what we're seeing here in this market, we're looking at the Aussie dollar against the US dollar. We see that this market is in a downtrend on the daily chart until that point. Now, just recently, price, however, has started to move higher. We have made a high here, and then the market formed here a higher low. Next thing that we see is price made another new higher high, and we've pulled back now to a low. It's not sure if this low is yet in place or what's going on there, but clearly we have higher highs, and currently it's still a higher low. So currently the daily chart has already shifted back to an uptrend. However, if we have a look at the weekly chart here, let me make that a little bit larger. Guys, if you can't see things, if things are a little bit too small or whatever, just let me know. And I'm not sure why I can't. It doesn't like me right now. Guys, sorry about that. Just a moment. We try to fix things. Let me just do a very quick check, sound check and so on, if you guys can still hear me well, while I try to work around those issues here. I'm just curious if it's really just an issue here with TradeStation, or if the connection is gone for good. I can hear you. Perfect, guys. Thank you very much about that. And yeah, really a pity that my charts are now crashing and dying on me. All right, so while the charts are still up, let's have a look at what's going on here. Sorry that I can't give you the bigger picture there. The idea that I have here is the weekly chart is still in a downtrend, and I use my blue 20-period moving average and the black 10-period moving average to help me to identify so-called price equilibrium levels. Maybe you guys have heard that price is mean averaging, which means price moves away from those moving averages, and price can move quite fast for a time, but then from time to time it has come back to rest. It's just like an elastic band, a rubber band, and then it snaps back into place. And we have seen this here. We have broken out of that tight range here. Price moved away, but then it came back to those moving averages. Price can never move away from those averages for too long. I don't say that price has to snap back like it just did here. It can also move sideways so that the moving averages can catch up. But overall, the idea is always that price moves to those moving averages, And at one point in time, then the market might be ready for the next leg, either up or down. We'll have to assess the trend strength then. So what we're seeing here is on the weekly chart, the price is now just pulled back to those price equilibrium levels. And we're currently seeing here a small indecisive candle forming here on the weekly chart. It's just Tuesday. If I wanted to trade that weekly chart here, that candle should have been over. If I saw a candle like that here on Friday in the afternoon, I knew, I'd know that my first trade Monday morning would be a potential short position here if all the other stars and factors align in the Aussie on the weekly time frame. The daily chart, however, has shifted here to an uptrend, and unfortunately, TradeStation doesn't give me here my 2-day chart. I'm pretty sure that a 2-day chart would have put me here currently still in a downtrend and as a pullback also right into equilibrium levels. So here right now you could make the case both from the daily chart for a potential long trading opportunity. Very early, it doesn't meet our rules, but just coming from a trend perspective here. Or on the 2-day chart, you could argue that this might be a potential short trading opportunity. What is the best time frame to trade? Well, ultimately, you would like to see and would want to see that those time frames are in agreement and tell you and give you the same story. And all right, good thing, at least I have my screen back and the charts are gone. Sorry about those technical issues and glitches here. So let's have a look here at the Nadex platform. The idea is, let's just assume I want to initiate a potential short trading opportunity. Now, let's have a look here. If I'm already here at the Aussie against the US dollar, the first question that you have to answer for yourself is which time frame, which expiry cycle do you want to trade? I'm looking here at the weekly chart, the weekly not chart, at the weekly contracts. Those weekly contracts here, let's put it up here. All right, the weekly contract gives me 3 more days for things to work out. You have to consider time when it comes to trading options, because it's not just, I think the price will be above the strike price. All right, but when do you think price will be above the strike price? This when is a crucial component, and more time for things to work out, more time for price to go against you. However, if you have a look at, let's have a look, for example, here at the built-in charts, and what we're seeing here on those built-in charts, let me just try to go here to a 5-minute chart. And you can see that on the 5-minute chart, same technical analysis is applied. 10 period, 20 period, 50 period moving average. And you can see here, prices started to make new lower lows, lower highs, lower low, lower highs. Price has pulled back. Where has price pulled back to? Into my moving average sell zone. And then we start for the next leg lower. Here, we're setting currently up another bearish candle, a little bit of a deeper pullback. However, the 5-minute chart thing suggests to me that this market might still be going lower. If I want to trade that 5-minute chart, I definitely would not have a look at the weekly chart, weekly contract cycle, and try to trade that. However, if I think, yeah, that's a nice thing to do here, I want to keep things really, really fast. We could be looking here, for example, at the dailies and the expiry cycle, which ends in 2 hours and 26 minutes. And so the question is, where do I think will be the price of the underlying, which I can see here, in 2 hours and 25 minutes? Where is price currently trading? 72.522. So 72.40. Those contracts here are those which should be at the money. One is above, one is below. And I assume the price for those should be somewhat around 50. Let's have a look at those here. And sorry guys, I have some issues here. So the one is trading up, is currently in the money. So the price is above 50. And the other one is currently out of the money. So the price is below 50. Now, if I think the market might be going lower, what I could think about would be having a look at that contract and thinking about selling that contract. Again, just for demonstrational purposes, not a trade recommendation. I think the market might be going lower. I want to sell this contract here, 72.40, and this means the price should be shooting around this level here somewhere. Do I think that it's likely that price will drop below that 72.40 level within 2 hours and 24 minutes? If I think, yeah, that's true, that's my deal, let's talk about selling one contract. My maximum loss now is $15.75. Why? Because I can sell this contract now for $84.25. Think about what I told you before. If I sell this contract now, the worst thing for me to happen is the price stays above the strike price. I have to settle this contract for 100. I just sold it for 84.25, and that's just the difference here, 15.75. Guys, commissions and exchange fees are not considered here. It's really just about the pricing at that point. Keep that in mind. So I've talked about how easy it was, or how easy it is to implement proper risk management. How would I do that here? I'm having a demo account here with an account value of $23,000. A rule of thumb for my trading style is I want to risk 1% of my account on any one given trade. So if this trade doesn't work out, I will lose 1% of my account. So this means I want to lose $232 roundabout. I can see how much I can lose with one contract, and I don't even have to do the math. I just, like a madman, keep clicking here on that button. And you guys, you can see 236. Yeah, we'll be okay. Let's shoot for 40. Risking 1% of my account allows me now to potentially short 14 contracts here. Does this make sense, guys? Both the risk management aspect, which is ultimately tremendously powerful, and the other thing, why I'm looking at that contract, why the reward to risk ratio is in my favor. But again, it's not a recommendation. It's just illustrating this idea. I want to have a decent reward to risk ratio, and I still think that the market might be able to push in that direction. Let me just place that order now for 84. And you see that position is already live. Now, how can I manage that position? I told you guys before that I can now just relax, lay back, no matter what happens next in politics, in the industry, in business, in weather forecasts, no matter what the impact on what the influence might be. If things go really, really bad, catastrophically bad, how much can I lose? I can lose my $224, or how much it was. That is my risk. This is all the fire, all the heat that I'm currently taking. That's it. With stocks, with futures, depending how you play regular options, but play vanilla options, your potential losses could be way, way larger. If those markets gap against you, things can get ugly quite fast. Here at Nadex, not. I know my risk up front, and especially when you're starting out with trading, guys, this is such a powerful feature because risk management is there for survival and make sure that you wipe out your accounts. And this happens pretty much to everybody. And this here makes it so easy to set up a plan, follow that plan, and then stick with it. Very, very powerful thing. Now, I can actively manage that position. I don't have to wait and hope and pray. What I can do now is that I can say, for example, that I'm looking into buying some of those contracts back. I sold those contracts for 84, so I took a risk of 16. Now, if I say I want to buy back 7 of those contracts at 68, how far is 68 apart from those 84 which I just sold? Should have been 16. if I was able to do the math in my head correctly. If I take partial profit on my short position of 14 contracts here, this means that I've pretty much I've eliminated all the remaining risk on my trade, because the potential profit that I could have locked in by shooting for just taking 7 contracts off at 68, I just have pretty much doubled my money at that point. I had a risk of 224. If I shoot for 68, that position at that point in time should be worth something like double, 2 times 224. If I close half of my position then and there, I've made a good part of money, and I can still potentially lose a good part of money. Those 2 parts cancel each other out. So at that stage, taking half my position off at a 1-to-1 profit target, 84 means I have $16 risk, but if I lock in after a profit, a potential move that gave me another $16, I can cancel the remaining risk part. So if I hit that first profit target here at 68, my position shouldn't be able to lose any money. Again, exchange fees not considered here. So let me just place this. So now I have a plan, and I don't have to monitor that plan. I don't have to watch the market at that stage, because my order is in, and I know if the market moves there, another exchange member wants to take the other side of that trade, my order will be executed. And I just don't have to manage 7 of those contracts. I could now put in another one and say, okay, let's do it. Other idea could be that I say, all right, of those now 7 remaining contracts, I want to take another 4 off if we hit 50. So if we dip and trade at the strike price or very close to that, then I say, okay, that's nice enough. I take another 4 of those off. And then after that profit target might have been reached, I still have 3 contracts on. At that point, I already have realized profits and will have made a profit on that trade if the market moves in my direction. Now keeping 3 more trades on and really shooting for that expiry below or at the strike price in order to give me that full payout of 84, which I just got for selling that trade. Guys, does this make sense? Do you have any questions? So the first idea was I want to see that the market is moving in a certain direction. Then I want to identify a potential trading opportunity, and then do I decide how do I want to implement it, binaries or spreads? And if it's a binary, what is my time frame? Which expiry cycle should I go? If I thought that I wanted to go initiate that potential short trade with this contract here, which is definitely currently out of the money, you can see that I'm risking here $85 for a potential profit of just $14.25. Doesn't make any sense for me at all. Yes, I have a better probability that things might work out for me, but the reward to risk ratio is just ugly. I don't want it. That's my style of trading. I want to balance those things, and the balance that I got there with 84 was a very nice reward to risk ratio, and still just eyeballing the chart and thinking about what was going on there could make sense, could be doable. All right. Quanad, I have no idea what you mean. Sorry. Just reading through the questions. Guys, do you have any other questions? You see the market here, pulled back to price equilibrium levels, larger candles getting smaller, more indecisive, bearish candle, another bearish candle, then the market starts turning. Does this work every single time? Absolutely not. If applied in the correct context and content of technical analysis, does it work often enough to be potentially profitable? Absolutely, definitely. So That trade is on. Honestly, I don't care about the outcome of that trade because it was really just there for demonstrational purposes. Guys, let me do a quick recap here, and just quick reminder, if there are questions, please let me know. Binary options here at Nadex. Binary options provide a fixed risk without a traditional stop loss. I have not incorporated a stop loss. I didn't have to tell the platform now or use in my strategy here, oh, if the market moves against me, I want to be out at 90. I could do that, but it doesn't make any sense for me because I scaled my position down to a level that I say I know my maximum risk, and I just implemented a position size which is in line with my money management techniques. No need for a traditional stop loss. I know my risk upfront, and there's not a risk upfront which should be something like that. No. If everything comes to an end and finance should be our last and least problem, I still know that this is the maximum amount of money that I can lose. Very, very comfortable position to be in. Just me. I've been in other positions. Trade worldwide indices, foreign exchange and commodity futures from one single account. No wiring, no shuffling around, no depositing, no moving money around to access those markets. It's all there and yeah, accessible from that one account. Also makes it, of course, easier to diversify those markets. You don't have to trade those same indices, which you might think are overbought all the time. No, you can go long, you can go short, and you have access to all those other markets out there. Nadex provides the trading platform with full direct market access execution. Minimal capital outlay, contracts under $100. It's very easy to get started. No day trade. Sorry guys, I always screw up the name. No pattern day trading rules, which say, all right, you are interested in stocks, please send 25,000 bucks. Otherwise, you are pretty much restricted from trading those markets. Little amount required to get started and still be able to apply full risk management and thorough position sizing. It's not gambling. You must have a plan. Keep that in mind. Have a plan and trade and execute that plan. High reward trading with limited downside. Your risk is always capped. All right. All right, guys. So let's just move on here to the last slide. If you don't have any further questions, then thank you very much for tuning in and attending this webinar. I hope you learned something new. You heard something, something useful. Guys, give it a shot. Have a look at those demo accounts. Get a feeling for the platform. Get a feeling for trading those markets. And no need to put down any money. Those demo accounts they had been in the past for 14 days. Good news, unlimited access now. Take your time, play around, understand the interface. Very easy thing to do. I think after 5 minutes, you're up and running. Practice. Just get a feeling for how everything works. If you do have any questions after this webinar, you see different ways here to be in touch with Nadex. Shoot those guys an email. Fill out the contact form on the website, and yeah, they will definitely more than happy to be in touch with you and help you there with any questions that you might have. All right, guys. So I think that's it from me for today. Thank you very much for tuning in. I hope you enjoyed it. Something useful for you.